This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
We're going to channel Kevin Bacon's character from the movie Animal House on this week's show and encourage you all to remain calm. We'll look at what not to do in a market that appears to be heading lower, consider why it might head lower, and disprove some of the approaches to avoid if we do head into recession. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and this week I'm kind of going to start with the conclusion part first before getting into details of my thoughts on what's transpiring. But in a moment of clarity, to start off with a reasonable perspective on where we really are. Obviously, the volatility has been, I'll concede, a bit remarkable. I won't say unprecedented, although some of the ancillary or adjacent areas of the markets have been with little precedent. And I'm talking about the moves in some of the bond markets and currencies. And I may circle back to that. But with the broad-based indices we commonly use, the S&P, the Dow, with them down less than 10% for the year, after a few years of really tremendous returns here, it's really not that challenging to see them pull back 10%, which they have from their highs. They are down 10% or more from their recent all-time highs, but less than a 10% decline for the calendar year. It's not that big a deal. At least not in an absolute manner. In an absolute manner, the bottom line of those returns, hopefully the bottom line of what's happening in your overall portfolio, is not remarkable. You know, I'm not being cavalier about losses. People don't like seeing their portfolios go lower. But if you're going to actually, and I've heard tones of this, if you're panicking with a market pulling back 10%, in this case panicking at less than a 10% loss, then you would maybe be somebody who can't handle investing in stocks. Most long-term financial plans require some prudent risk. So we either need to change the assumptions to allow for an assumed return on a zero-risk investment strategy, or adjust our reactions and take a breath. But I don't want to digress too much here. Obviously, we've seen many worse times in the markets, but perhaps the elevated levels of anxiety portrayed in or created by the headlines we see daily, maybe it's exacerbated because so much of this volatility is self-inflicted, and with that, it carries an unknowable level of potential of getting worse. It seems to be elevating the anxiety beyond the levels one might expect relative to what the markets are actually doing. But now, after a couple of really big years in the market, if we now reel in risk a bit and have a portfolio based upon a financial plan that's built on a foundation of conservative assumptions, modest returns, higher than normal inflation, and realistic spending assumptions, then it won't be hard to weather what may continue to happen, what may come next this year. At this point, my philosophy is I'd rather regret missing a huge upside rally here than regret participating fully in a potential continued downside. But with these foundations in place, we can judiciously apply a reefed level of risk in our portfolios. And for those who may not know, when you are sailing, you're on a sailing vessel and the winds are really picking up to troubling levels, or you're running into a storm perhaps, well, you can't always just bail out. You can't just head over to shore. And you don't want to take in all of your canvas, but you do reef your sails. You reel them in partially. You reduce the amount of canvas that's exposed to that wind so that you can keep sailing without being subject to all the force of that elevated risk. And we've seen some pretty strong rallies in reaction to these kind of daily vacillations in our trade policy. And that's a good sign that the markets kind of want to trade higher. That's a sign that there's a kinetic energy still within the economy, within the investors, with the cash on the sidelines, with the fundamentals of the businesses, that they have this energy to go higher if some of the worst of the news would just get out of their way. But on the other hand, we also haven't really yet seen the full effects of what the tariffs may ultimately bring, as in higher prices actually showing up on the shelves of the stores, higher levels of unemployment, even lower consumer confidence than we have today, and yes, the potential for a recession. So, as investors, we refin the sales in our portfolio, raising even a bit more cash, pulling back some of our stock exposure, as we came into this year with a market that was broadly already trading at pretty rich valuations based on expectations for earnings that were pretty optimistic about what was going to come in the form of strong growth for next year and the year after that and so on. And those expectations have now been pretty strongly called into question. That's the squall, the storm on the horizon, so you reef your sails. And I started saying here on the show in the fourth quarter last year that we expected to start this year by confronting the negative effects of tariffs. And what caught mostly everyone by surprise in early April was the absolute scale and the methodology of the tariffs that we now may be facing. And now there's been some holes punched into these assumptions as there have been pauses and exemptions applied. But I also said last year that there would be positive consequences for the markets that would appear later on. The positive consequences from lower regulation and the continuation of lower tax rates or potentially even lower tax rates that would boost corporate results. The question that lingers, though, is how much damage may be done before then. If massive trading restrictions are applied or remain, or if they're instead, maybe they're just a strong-armed negotiating tactic, and that remains to be seen. So today, we reef the sales of our portfolio. We don't lunge at sell-offs trying to buy stocks that we think are cheap. We don't lunge at them as if everything is suddenly on sale, but we take a measured approach so that we can continue on a sustainable path for our clients based upon a strong and conservative base of assumptions in their own financial plans, and we stay on that path. And that being said, there are some details worthy of being discussed today, and I'll be reflecting on them. So I'm going to take a quick few moments here for a break, and I'll return with that in a moment. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be right back.
Almost everything that lagged last year, value, international, and more defensive stocks, are first out of the gate here in 2025. Is this a knee-jerk reaction or a more sustainable trend? Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about where to find the best future opportunities and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. And getting back to the very fluid details of what's happening in the markets, as we're also now in the middle of earnings season. Well, good luck out there looking for forward guidance. I can't remember seeing it stated like this before. I'm not saying it never has, but I can't recall. But as we as investors look to not just the company's results when they release their quarterly results, but we look to their guidance for what they expect for the full year, what they're seeing in their orders, what they expect. Well, these companies are hedging in a way like I can't remember really seeing before. And we've been through tough economies and markets before, but it's, I guess, exceptionally high level of unknowableness. Maybe I just invented a new word for this current economy. One of the major airlines this past week posted what was initially received as really strong results for the first quarter. But when they got on the conference call, within the guidance that they released, was this huge qualifying statement. They guided full-year results in two ways. What they expect to happen this year, which was actually quite strong. Here's what we think is going to happen for the rest of the year. But then a second version of it, of what they expect to deliver if the U.S. does dip into recession. Because they're not seeing it in the numbers now, because the elements that may lead us there are on pause, or they come and go. But if they come, if we do dip into recession, they expect that their earnings are going to be about 25 to 30% lower for the year. So that's not really guidance, not guidance that's very useful for much, other than to show that they have little confidence in the underlying conditions today. And one way or another, that's been the message of these times. No conviction on what the outcomes are going to be. This can be seen in what was basically I guess it was really a more optimistic report from Goldman Sachs this past week, more optimistic than their previous report, because the crux of it was they were reversing their previous report, which was published hours before. And this is the perfect example of the whiplash present in today's market. In this report, they said, quote, following President Trump's April 9 announcement that the supplementary portion of the April 2nd reciprocal tariffs will be paused for 90 days, we reversed the U.S. recession call we had published less than 2 hours earlier. Implementation of this tariff would have pushed the 2025 effective tariff rate increase to a likely recessionary 20% plus level, and delaying and perhaps ultimately rescinding the supplementary tariff should limit the increase to a number closer to 15% we had expected before April 2nd, even considering the prospect of additional tariffs on pharmaceuticals, semiconductors, and other critical goods. We estimate that a 15% increase on the tariff rate will cause U.S. GDP growth to fall from 2.5% in 2024 to 0.5% in 2025 on a quarter-over-quarter basis, but will not trigger a recession, end quote. And another important takeaway here, though, is that while they're focusing on this kind of binary question of recession or not recession, they're really talking about the difference between a 0.5% positive economic growth rate and drop it into negative territory. And as investors, the recession word is thrown around a lot as if it's this kind of sign of the apocalypse. But not only is a recession not the end of the world, but growth that's 0.5%, slightly above zero, shouldn't be trumpeted as some great victory. I mean, there's difference across the entire economy between negative 0.5 and positive 0.5 is only a 1%. Obviously, it's a 1% difference, but what that means for labor and earnings and everything else is that 1%. It's not really that different than if it was 1% and 2% or negative 1 and negative 2, if you get my meaning. It's really just a discussion of how lousy will this economy be, and few think it's going to be very good here. Jason Zweig recently wrote, quote, while people need good advice, what they want is advice that sounds good. The advice that sounds the best in the short run is always the most dangerous in the long run. Everyone wants the secret, the key, the roadmap to the primrose path that leads to El Dorado, the magical low-risk, high-return investment that can double your money in no time. Everyone wants to chase the returns of whatever it has been the hottest and to shun whatever has gone cold, end quote. And we're seeing a few versions of that today. There's the simple all or none version where people adapt to the reality that this isn't likely going to be a very good year in the economy, so they react with the inclination to sell everything, or at least a very radical maneuver, something along the lines of sell everything or mostly everything in their portfolios. And if they actually do execute something like that, they better be right if that strategy is going to lead to any type of better outcome than having not done that. It's poor, usually a pretty poor way to attack these markets. The other version is something along the lines of trying to figure out what's the safest part of the markets to buy into. Along the lines of a favorite quote of mine, which I can't really quote on here, but picking up a piece of you-know-what by the clean side. They may look to buy European stocks, or maybe they're going to buy only American-centric companies. They're going to buy more resilient utilities or other defensive sector companies. But these investors overlook the option of not buying stocks or judiciously reducing their exposure to stocks, not that like that former sell it all reaction, but in a reasoned approach. So you don't have to say, well, which is going to be the least bad stock here? Just you can reduce your risk exposure. And it's tough because you miss having that double-digit return that we've had these last few years, and you have that regret, that the feeling that it could still be going. The markets could be headed higher, and you look to overturn a stone that might lead to superior returns rather than mitigating the damage of negative returns in a year like this. I saw this in a presentation recently from a pretty well-regarded professional investment manager who runs this long-short investment fund. They both buy stocks and they short stocks within the same portfolio. And while their underlying economic thesis appeared solid, the approach that they're selling just didn't hold water for me. They focused on why markets will struggle this year, but that some areas are going to be less bad than others, and maybe because of a conflict of interest that they have, because their job is to take in people's money and invest it in stocks or in this portfolio that's going to either buy stocks or short stocks. But in truth, if their underlying thesis is correct, they would ultimately be more successful in discounting out that long side of their equation and focus only on profiting from shorting some stocks and otherwise preserving capital. And for what it's worth, we don't short stocks, but we can adjust our allocations by reducing our risk in our portfolios. We are able to pull back from them. We won't be shorting anything, though. According to an article this past week from the Wall Street Journal, their survey of 64 economists in both business and academia have lowered their forecast for GDP growth in the latter part of this year down to 0.8%. And I should have noted the exact timing of this. It's probably it was this week. It was similar timing to that Goldman Sachs piece. So Goldman was at 0.5. These 64 economists put their heads together. They got to 0.8. From a previous response of this same surveyed group of plus 2% growth that they had when they were surveyed in January. In January, there was talks of tariffs, and here on the show we talked about them, and lots of folks made some moves in anticipation of them. But surely what we are seeing now is a reaction to the scale that I don't know if anybody, but certainly few anticipated in the announcements that came earlier this month. The group also increased their odds of a recession this year up to 45%, versus that same group responding 22% chances of a recession when they were asked back in January. And part of the problem here, well, really, I guess the lasting problem now is twofold. One, we're all collectively reacting to this unknowable nature of all of this. Will the tariffs in some large fashion remain in place for a long time, or is it this hardline negotiating tactic? Without knowing how much the tariffs are going to be, because they're all on and then partially off and then there's exemptions, well, they continue to change every single day. And for how long, it's impossible to model their effect on earnings. But many estimates are just already equating them to a tax hike on consumers and businesses equal to about a 10% tax hike, with potentials for it to be much worse than that. What's more, no one's really demonstrating with any real clarity how far the effects of this is going to ripple. I mean, we're looking at guesses, much like that of that airline's guidance for the year, of how they're going to affect earnings, but we haven't yet seen them appearing literally on the shelves of the stores across the country. You know, many people out there are saying that this is a Wall Street problem, and this is not a Main Street problem. But what's happening really is that Wall Street's trying to guess at how bad it's going to be on Main Street, which leads to the second remaining problem and my final thought for this week. Not only are the tariffs to some degree going to have an effect on prices and on consumers and on corporations this year, but that will continue to build on the minds of those consumers and the decision makers at those companies. And already we're seeing consumer confidence data at levels that are below the levels that we saw in 2008 during the great financial crisis. According to a piece this week from Apollo Global, their reading on the April survey of consumer sentiment from the University of Michigan saw those sentiments, quote, declining rapidly both for the households making more than $100,000 a year and those making less than $100,000 a year, end quote, as they parse different segments of the economy. And to paraphrase some of their other takeaways, consumer fears of losing their jobs are at levels only typically seen during a recession. A record high portion of consumers think business conditions are worsening, and inflation assumptions in the survey are rising at unprecedented speed. And according to Raymond James' own Larry Adam from this past week, referring to the University of Michigan survey, he says, quote, the University of Michigan survey reported that sentiment fell to 50.8, the second lowest reported level since 1952. A good portion of what he wrote was pointing out here that the percentage, and that was the end of that quote, a portion of what he wrote was that a portion of bearish investors from the American Association of Individual Investors, AAII, that survey remains above 50% for the seventh straight week, which he says was tying the longest stretch since 1990. And my takeaway from that is it's actually a positive, which gets back to that thought earlier of the kinetic kind of latent energy in the market to go higher. Because that survey is historically a contrarian indicator. So let's not over-leverage to this all as a sky is falling thesis. The fact that for 7 straight weeks, the longest stretch in 35 years, the average investor in that survey has been bearish, that itself is a positive sign here. So if things don't get worse, the risk may be to the upside. I just think that the risk is that things are going to get worse. The bottom line is that with all those people that are making decisions at firms, whether to invest in capital or invest in by hiring new employees, are those consumers deciding if they are free to spend or not, with them both feeling more and more like we could be entering a recession. Well, it's often been a self-fulfilling prophecy because it's these people's defensive reactions to those worries and the lack of spending. That's exactly what's usually the straw that breaks the camel's back and takes us into recession. I emphasized in a podcast in the fourth quarter last year to focus on the consumer. Can the consumer keep it going this year? And so far, the results are just not encouraging there. So as I finish up here for the week, remember to be careful that we're focusing here on exposure to risk, not capitalizing on fear, not yet at least. And don't look for yes bad, but for now, let's look for safe. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.